Good morning. I don't know why I said good morning, because it's a great one. Welcome to the Street's opening bell here from Post 35 on the floor of the New York Stock Exchange. That's true. This is not a green screen behind me for those of you who have been otherwise confused. It would be a very convincing one, though, to be fair. Today is Wednesday, the 7th of December. I'm your host, JD Durkin. Opening bell rung just moments ago by Valaris here on the floor. Taking a look at how the major indexes are kicking off this hump day. Stocks are, well, they were trading down the red fractionally, and that's probably a similar story. The Dow down 1/10 as we speak. This amid the economic slowdown continuing to weigh on broader investment sentiment. Investment sentiment is a bit of a tongue twister, to be fair. Investors are beginning to lose a bit of faith that the Fed will actually be able to pull off the so-called soft landing. Remember the epic soft landing news cycles? We'll see what happens. Taking a closer look at what is on tap for this morning's broadcast, we will talk the latest on the market rout as investors look ahead to a series of fresh economic data. We love fresh economic data on the show. Plus, we'll talk the latest out of Tesla as the EV giant unveils further price cuts in one of its largest markets. And finally, yes, GameStop set to open or report earnings after the bell today, rather. We will tell you what to expect. They're also set to open stores, I guess, for the business day. For more on those stories and so much more, we now welcome back our chief markets correspondent, Martin Backerdax. I say welcome back, Martin, because we certainly missed you yesterday. So let's begin there so I can get your perspective. Another big rout for investors. That's kind of the tail of the tape a few days in a row. What drove the downturn yesterday to set the stage for today?
I think really now we are starting to be caught by the gathering winds that are facing the global economy right now, certainly in China, also in Europe, and indeed here in the United States, JD. So I think collectively, the perception from last week began to shift from concern about inflation to more concern about growth. Not that inflation has disappeared. In fact, it's my sense that the signaling that we have received from the Federal Reserve over the number of months now that they are committed to the inflation fight has only cemented the idea that they're going to keep rates elevated for a long time and therefore probably as a result tip the economy into recession. So we just had this gathering selection of not only data points but commentary from significant CEOs in public life, JP Morgan's Jamie Dimon being one of them, that all kind of pointed to weakness ahead. And again, I do think that the markets are simply just coming to terms with that and resetting expectations into the end of the month and into the start of next year.
Talk to us a bit more about what you think might have investors so skittish. I mean, obviously we lead our conversation seemingly every day, and rightfully so, with regards to what Mr. Powell and his colleagues are doing. But this, as we do see the S&P 500 extending its losing streak to 4 sessions. For someone who's watching, maybe even Martin, someone who maybe only checks his or her portfolio once a month or once a week and says, what the heck is going on? What should that person know as we're now halfway through this week as we get into Thursday and Friday's trading session soon?
No, I mean, it's a really important question, JD, because at the end of the day, what we do is not an intellectual exercise. We want to set people up so that they can make sound investment decisions or at least have a greater mosaic with respect to make those decisions. And I think really now we have to be coming to terms with the fact that the economy is weakening. Now, if you were simply to look at data as a snapshot today, that would be a hard argument to make. Labor markets are still expanding. We added 263,000 new jobs last month. Wages rose more quickly than anticipated. A decent barometer of economic activity over the month of November was very solid. And in fact, prices paid were starting to fall whilst employment was starting to rise. And the GDP Now forecasting tool from the Atlanta Fed points to growth at around 3.4% for the fourth quarter of this year. None of those indications would suggest that we are looking into the base of a near-term recession. But again, commentary from some very important people. JP Morgan's Jamie Dimon talking about the fact that Fed rate hikes will probably erode consumer spending power into next year and therefore create a pullback in retail spending, in business investment, and possibly ignite recession. Those comments were echoed by other CEOs as well, David Solomon from Goldman Sachs being one. So we're starting to see those pressures rise as well. The bond market has been flashing inflation signals for a number of months now, JB, and the difference between 2-year Treasury note yields and 10-year note yields is right around 83 basis points. That's almost a full percent. That's the steepest decline we've seen since the early 1980s. And in almost every instance, after a decline of that, after an inversion of that magnitude, we've had recession over the coming months. So whilst the today picture is solid, it's the near term that's so much more sort of uncertain. And as a result, as I anticipated, it seems as if markets are now switching away from Fed talk and more closely focused on how companies can navigate this weakening environment and what it will mean for earnings projections. And that, I think, is going to be the driver for performance next year. So to your larger question as to what people should do when they're looking at this situation, they should either be passively invested if they want to maintain and ride this out, or be very selective and very conservative in a bias towards defensive stocks if they want to try and trade their way through it, which will be a difficult task, it has to be said.
Absolutely. The constant maturity between the 10-year and the 2-year, like you said, 83 basis points or 0.83. And we've seen that number tick up here, Martin. Just looking at the last few weeks, at the end of November, it was only 70 basis points, which is still a lot with regards to it being inverted. But in terms of just showing from 0.7 to 0.83, that shows how quickly those metrics have moved in just a few weeks. To this point about Jamie Dimon, you made an interesting point to say because the Fed will continue to raise interest rates, it will erode consumer spending power. But it's also been interesting to hear other CEOs like Jeff Bezos sort of get out ahead of it and actually advise people to cut back on spending. I'm reminded of what Jeff Bezos has said the last few weeks to say if you've had that dream purchase, that flashy flat screen TV you've always wanted, now is maybe not the best time to make that type of purchase as we continue to tighten the belt. It sounds like Bezos and Dimon are basically saying the same thing. Bezos is just sort of giving it in terms of advice to the consumer, whereas Dimon is sort of reacting to what he thinks the consumer will end up doing. Either way, they're mostly on the same page. Is this in line with other popular CEO thinking?
It seems to be so, JD. I think one of the difficulties in describing that situation is how irrational consumer spending can be at times. People don't always spend money in circumstances that are in their best interests, although for the broader, in the broader perspective, they are aligned with their employment prospects. So ultimately, if employment can stay as robust as it has, that will probably give a little bit more leeway for people to spend. And we've seen evidence of that heading into the November Black Friday, which was much stronger than anticipated, and suggested that consumers hadn't run down their post-pandemic savings and were willing to extend a little bit more as a result of them feeling comfortable about their job situation. I do imagine that will change into next year, because we're starting to see more and more headlines about job cuts, about layoffs, about paring back costs at some of the biggest U.S. companies, and that in turn will probably lead to a pullback in hiring, and then of course there'll be a corresponding pullback in spending as well. But to this point at least, it's been reasonably solid. What's interesting to me, JD, is what you were saying about the Treasury bond curve and how that to some degree illustrates this dynamic right now. Essentially, because the Fed is going to stay as aggressive on its rate hike path as it is, 2-year note yields will remain elevated to match the anticipation of the terminal Fed funds rate. But at the same time, investors are worried about long-term growth, and therefore they are being defensive in purchasing 10-year Treasury bonds. When they buy them, the yield falls. So you get concern about near-term inflation and concern about longer-term growth. That is where you get that inversion from. So to some degree, what is a complicated sort of dynamic to explain is being played out very simplistically in the difference between these 2-year and 10-year notes. And that's why investors at the professional level are so focused on the yield curve, because it tells that story in sort of an elegant way.
Of course, we will have the very highly anticipated Fed meeting coming up next week. I believe that's on the 14th. And you and I talked earlier in the week about some of the key pieces of economic data to expect between this week and next week. What are other pieces of data or economic reports that you're following in the coming weeks? If anyone's sitting there with their calendar and they say, hey, I want to be best prepared for the month of December, what little pieces of info should I be following?
Yes, I think ultimately the most important figure is going to be the November inflation number that we get just prior to the Federal Reserve rate meeting in the middle of the month. And I think ultimately that will sort of give us an understanding of where we're headed on price pressures and whether or not the stronger than expected November employment figures are feeding into consumer prices at the same time. Wages in the month of November accelerated much more quickly than economists had forecast. And it will be interesting to see whether there's a corresponding jump in inflation at the same time. And you could certainly make that argument if you look at the level of increases in Black Friday and sales over that Cyber Monday weekend. So I think that will be the most important one. There's consumer sentiment data on Friday as well from a very closely tracked survey that's conducted by the University of Michigan. It will be interesting to see how consumers are feeling about that. It's very often linked not only to pace of acceleration in the job market, but also the broader movements in benchmark stock indices, because people's longer term wealth is so closely tied to it with 401ks and investments and all the rest of it. So a pullback in stocks may elicit some more pessimism from that survey, and as a result, that could be self-fulfilling in terms of the expectation of weakness heading into next year. So those are the figures I think I'll be most focused on as we sort of head into that glide path where volumes will fall off precipitously after the Fed decision next week.
Will this likely continue to be a case of good news is bad news, meaning what's normally very positive economic data actually indicates a bit of a rough road ahead with regards to how the Fed reacts to that otherwise good news?
I think it's going to be a mixed bag, to be perfectly honest, which is going to make predictions so much more difficult, because I think bad news from the economic front won't necessarily be seen as good news with respect to companies being able to generate earnings growth, because they will see that as just an erosion of the power of their customer base. But at the same time, sort of a compounding sense that the economy is heading into a downturn could elicit some change of thought from the Federal Reserve. However, their messaging has been pretty consistent that they feel that the economy is not heading towards recession, at least on their baseline assumption. And even if it were, it could probably withstand a shallow one as they tame inflation in the near term, because they see failing that task as having more dire consequences for the economy long term than pulling back today and juicing the economy on a short-term basis for just a few months.
Marna, I wouldn't pretend I wouldn't pretend that everyone who's watching this show works for a big tech company by any means, but those are the companies that disproportionately we've seen a lot of headlines with regards to layoffs over the course of the last week to the last several months. But, look, I would argue that if the Fed is going to be successful, then yeah, you're going to see unemployment creep up perhaps quite a bit north of where it currently sits, which I believe is at 3.7%. So this is going to be something that impacts people, not just who work for the Metas, not just who work for the Amazons or the DoorDashes of the world, though those employees have certainly been on the receiving end of unfortunate cost-cutting measures. Do you expect that to worsen? Do you expect that to, I guess, worsen depending on which side of the equation you are, but do you expect to see unemployment continue to rise? And I ask that for a perspective of someone's watching who might not work for a Facebook or a Meta, but might be looking over his or her shoulder wondering if that person's company might be next.
Yes, I think so. And that's the unfortunate truth, JD. I think if I have the number correct, and I'm pretty sure I do, the Fed's baseline assumption for unemployment is that it will rise to about 4.4% by the end of next year. That increase between the 3.7% now and 4.4% in December of 2023 is certainly something that you would parallel with a recessionary environment. So it's not above and beyond that, but it's certainly enough to indicate that, yes, there's definitely more headline job cuts to come. They probably will also come from tech, but I would imagine they're going to be across the board. What's been interesting over the past couple of weeks, JD, is that the announced job cuts are coming in different industries and not simply just tech. We've seen them across media, we've seen them across consumer staples, and now in banking as well. Consumer staples with respect to PepsiCo, reports of job cuts at the headquarters there. Banking with respect to Morgan Stanley, and reports of them paring back there. Wells Fargo, of course, has already cut headcount in its mortgage division. So the breadth is now starting to be a little bit more troubling than it was in the fall of this year, even with the elevated levels of payrolls over the month of November. The breadcrumbs inside that, JD, seem to be, at least for me, what we are hearing with respect to advertising, ad spending, and marketing pullbacks. All of the tech companies are telling us that they anticipate weaker spending into the end of the year and indeed again into 2023. Now, some of it is put down to changes that we're hearing about in the European Union, and also Apple's changes with respect to privacy and tracking and all the rest of it, intense competition from TikTok and others. But the sort of base case now and the consistent messaging is that companies are pulling back on their ad and marketing spending, which is very often the first thing that they do when they see economic headwinds. The second thing that they do is to cut headcount at the same time. So the breadcrumbs and the connection that I'm seeing from advertising spending weakness to potential job cuts is very clear.
Not to be too meta, one journalist to another, but with previous downturns, I've long argued, and no disrespect to our profession that you and I love so near and dear to our hearts, but newsrooms are essentially extensions of advertising companies. And
Yes.
is there a thought to you, because I do remember this at the start of the pandemic, one of the big storylines was newsrooms laying off a huge percentage of employees. And I wonder, have we already started to see that, or will we see that? Because I would actually argue potential newsroom layoffs have been a bit under the radar so far versus to the splashy tech companies that understandably drive a lot of the attention. But the state of our newsrooms are directly tied to a global advertising pullback too, isn't it?
No question about it. I think, we've already seen evidence of that with CNN cutting back in its news division as a result of big changes there and the Warner Brothers merger. We had reports earlier this week that I believe BuzzFeed is going to sort of get cut down its newsroom headcount significantly heading into the end of the year. And of course, those are companies that are very reliant on ad revenue to support the cost basis of news gathering. And that's the sort of unfortunate truth of our industry, JD, is that news gathering, news reporting, and that collective process is incredibly expensive. If you do it well, it costs a lot of money. It costs money to send people to the destinations that they need to be in order to report the news correctly. It costs money to have people in their offices monitoring the data that needs to be picked through in order to present the kinds of stories that we give to readers each and every day. It's not a cheap process. It relies on advertising dollars. And when those dollars fade, the cost cuts tend to follow as A follows B, as B follows A, I should probably say.
Yeah, absolutely. And of course, that's not a newer phenomenon. Maybe the digital ad component is new to newsrooms, but this is really baked into the long history of, the tabloids here in New York, the history of the New York Times. There was always an advertising component that helped kept the business afloat over many years. It obviously just looks a lot different in terms of our ecosystem today. I do want to ask you about China, if we could pivot to talk about overseas, Martin, because every morning you give us outstanding perspective on what investors here need to know about what's happening there. One of the more incredible developments in the last several days has been that country loosening the conditions for showing proof of a negative COVID test to travel from one part of China to another part of mainland China. What parts of that overall story in that country right now are you most closely following?
Ultimately, it's been a bit of a surprise to me how quickly the Communist Party has been able to react to the process that we saw last month. And of course, those protests being linked to the fact that China is approaching the third anniversary of its pandemic and is still within the throes of very restrictive COVID policies as the government pursues this sort of zero COVID ambition. I think they're starting to jettison at least portions of that by loosening some of the more draconian restrictions. You talked about it just now with regards to the demand for a negative test to take public transport, with quarantine now being, at least for asymptomatic and mildly symptomatic patients, at home rather than in an official destination. And just kind of a further and gentle reopening of the world's second largest economy. Still a long way from free movement, and it will be interesting again to see how quickly these changes come into the Chinese New Year celebrations in early February. But they do seem to be moving in the right direction. But I was focused, JD, on export data which came out last night, which is very representational of the economic damage that this policy has caused. We saw the largest decline on a year-on-year basis in China exports since February of 2020, the teeth of the global pandemic. So this does indicate exactly how far and how beyond necessity these COVID policies went and the implications they have for, again, the world's engine room. So those numbers were arresting. It's a big part of the reason why we saw weakness in China stocks overnight, even as we had headlines from the government itself about loosening restrictions. So very quickly, the market pivots from are we opening to what's the damage and how long will it take for China to recover as a result. It's a fierce and indeed to some degree inhuman calculation, but that is really the essence of markets these days, and that's what we're seeing right now.
What helps explain the pivot? I laugh at that word because we always use it in a different context here, talking about stateside economics, but a pivot of a different kind. I mean, people obviously have followed the headlines with regards to the protests. We know the economic impact. Is there something firm that helps explain why in the last maybe 10 days or so, it seems as if the story has begun to change over there? Is it a more efficient vaccination rollout? Maybe a combination of lots of things.
I think probably the latter, JD. I think it's hard to pinpoint precisely why the government seems to be more concerned about public disquiet now than it has been in the past. Maybe they just wanted to make sure that the small protests that we witnessed in some of the larger Chinese cities didn't escalate, and that they didn't escalate at a time when the economy was at its weakest. The Chinese economy, apart from the worst of the 2020 pandemic, hasn't seen this kind of weakness in a number of decades, and economic weakness tends to have social implications. So I think the fact that the new government of Xi Jinping, and I say that because he's in the third term of his leadership, probably just saw this in a slightly different light as a result of those protests, but also the damage it's wreaking on the economy, because the best way for them to maintain the control that they have is to ensure economic growth and robust employment. And ultimately, the calculus that they have to complete is whether or not they feel that easing restrictions and the resultant spread of the infections that will follow is worth that cost in order to generate economic growth. It's a grim calculus that's taking place in Europe and certainly here in North America as well. China's just a little bit behind the curve.
That's right. It's always a grim calculus. What do you call it? The grim science, the dismal science?
It is the dismal science.
Described.
Absolutely.
Nice.
Yeah.
Yeah, and that's really being driven home right now when you see the effort of the central bank. And I think in terms of perspective, and I'll be honest, I got friends and family who don't nearly follow the stuff as closely as we do. When I try and break down to perspective what the goals of the Fed are, they sound so counterintuitive, as you know, when you say them out loud. But hey, you got to cool down the economy just a bit. I do want to stay overseas with a different story that also impacts China, and it's specifically Tesla. That company yet again slashing prices on its Model 3 and Model Y sedans for China buyers. It comes after reports that the company could be reducing output at its very prominent Shanghai factory. Cause for concern?
Certainly an indication of what that company is seeing with regards to demand on the ground. And therefore, as a result, I think it's very important. One of the great sort of achievements of Tesla over the past 2 or 3 years has been the ability to expand their automotive profit margins. For the longest time, the company was maybe criticized as too harsh, but it was noted that the company was generating sales growth, but not necessarily expanding profits at the same time. But now that Elon Musk has been able to get his arms around that broader scaling up process, if you will, he's been able to expand profit margins whilst also expanding volume production, and that is no small feat. And as a result, stock was rewarded significantly and hit those record highs in late last year. Now, it's been held down by a whole host of factors this year as we've gone through, the most important of which is probably the significant share sales of Musk himself and his distraction with Twitter. But the fact that I'm bringing up the margin argument is because it will be pressured this quarter as a result of price cuts that were put in place in October and these new discounts that we just found out about last night that will add to those October price cuts. So essentially what they're trying to do is entice demand over the final months of the year by giving people an extra discount, assuming and only if they take delivery before January. So it tells us a couple of things. Firstly, they are worried about demand in what has to be remembered is the world's biggest electric car market. And they're also willing to stoke that demand at the cost of expanding profit margins because they're going to be selling the cars at a cheaper level. So it will be interesting to see how that plays out in terms of the demand dynamic going into next year and what it will mean for their bottom line earnings that we'll get once the quarter wraps up at the end of this month.
What are some of the biggest headwinds the company is still facing as we turn the page into 2023, especially keeping in mind how the stock performed in 2022? That sound effect, I think, kind of conveys it, right?
530 billion in market value shedded, really, since the beginning of this year, which is just an extraordinary incineration of wealth. Again, some of it understandable, given the fact that Mr. Musk has sold so many billions in shares, and of course is distracted by this Twitter purchase. Both of those, I think, are going to remain headwinds for Tesla stock performance heading into 2023. But the China story is going to remain as important as it always has been, because it's the linchpin of their growth. And it is, of course, where they are building most of their cars to export, not only to that market, but to markets in Europe and indeed elsewhere. They're trying to get the Berlin factory up to full speed, and they'll probably do so in the latter part of next year. The same can be said with the Austin Gigafactory as well. Demand is going to be an issue in North American markets, certainly. If we get into a situation where the economy begins to slow and tips into recession, it will absolutely be a similar story in Europe as well. But so many people, from the professional investors on down, will advance the argument that Tesla's foothold in this developing market, which is going to be dominant in a few years when public policy basically puts an end to internal combustion engine car sales completely, provides Tesla with the kind of value that not only defines its market leadership, but the way that it can expand market share going forward. So this will probably be one of the most testing times for the Tesla diehards. And if this year wasn't enough to sort of, put their faith into question, next year might be as well.
Of course, first of all, I need to give you 10 points for use of the phrase incineration of wealth. It's an outstanding phrase. It's not the sort of thing we want to talk about, of course, as we do this. It's just very well phrased.
No, it's never good news.
It's not, but you turn a heck of a phrase, though. And I always write them down when I was like, that's a gem to keep for later. Of course, Elon Musk's priority seems to be elsewhere right now with his purchase of Twitter. It's taking a toll on Tesla. Do you think we're in, who knows, I mean, what the next year is going to hold, but will we see Tesla again become Mr. Musk's top priority? It's hard to imagine himself like tearing himself apart from the Twitter day-to-day anytime soon, seeing how volatile that platform is, but it becomes easy to forget that the man's involved with lots of other things, including Tesla.
He has a lot more near-term financial concern with respect to Twitter than he does with respect to Tesla. And that might be the ultimate thing that sort of defines where his attention is going to be in these coming months, because he had to borrow at least $13 billion and possibly more to execute the $44 billion purchase. And he said himself that it needs to be profitable in order to avoid bankruptcy. Now, I don't think bankruptcy is on the cards for Twitter just yet, but there's enough upheaval at the moment, of course, to demand his, if not full focus, at least a great portion of it. The problem that Musk faces, I think, to some degree, JD, is that these two companies, Tesla and Twitter, they're not counter-cyclical. In other words, if one performs poorly, the other isn't going to do well. The mechanics that are going to drag down Twitter are going to put pressure on Tesla's business at the same time. So if he needs to make Twitter profitable, he's going to have to challenge the headwinds of slowing advertising spending and, of course, the criticism that he's faced with regards to content moderation. Now, slowing advertising spending, of course, as we've discussed, is a precursor to a broader pullback in consumer demand and ultimately retail sales, both of which are going to have implications for Tesla's ability to grow its revenues into the first half of next year and indeed beyond. So he is going to be fighting a war to some degree on two fronts, both of them with different, but to some degree, flow.
Absolutely. Okay, let's talk to GameStop here with our remaining minute before we pivot over to Rapid Fire. That company set to report earnings after the bell today. What will you most closely be paying attention to for the folks at GME?
Oh my goodness, we're looking at probably the seventh consecutive quarterly loss. This company has just been not making money for a very long time, and I very much doubt that that's going to change from the numbers that we get today. Analysts are looking for a bottom line loss of around 28 cents per share. Revenues are probably going to fall between 4 to 4.5% from last year to around 1.35 billion, which is still a reasonably elevated level, but nonetheless, their expenses are rising at the same time, JD, and that's not good news, obviously, for investors who are looking for some kind of sort of a green in this company, and at the moment, it's just not materializing. When you speak about headwinds for GameStop, you're also talking about the fact that the video game industry itself, the titans in that space, are all predicting weaker holiday sales and a pullback on spending into 2023. They don't see it as recession resistant as it has been in the past, and that's going to flow through to GameStop sales at the same time. Another aspect to this story, JD, is the fact that GameStop has been trying to transition at least partly away from brick and mortar sales to a sort of a digital infrastructure in which gamers can buy and sell digital tokens, NFTs, and sort of other things that are associated with the games that they play on a blockchain network that would be managed by GameStop. I actually oddly think that's a really good idea. I think the company probably had a reasonably innovative approach to that transition in trying to erect this infrastructure, because it speaks to the kind of things that keep its customers interested, and it would be, for the most part, a unique offering in the video game space. But of course, that's facing challenges as a result of the crypto collapse, and even more specifically for GameStop as a result of its partnership, which it only inked in September with FTX US. Of course, that has come asunder completely as a result of the bankruptcy. So GameStop is facing challenges at the brick and mortar level, at the investor level, and indeed in its innovative idea to have this NFT and digital token platform as well. So not much is working with respect to this stock's ability to grow. I think it's down, I want to say about 40% so far this year, somewhere in that.
Mark, we just lost your feed for a second. I lost his audio. Did we lose a shot as well? All right, well, excuse me. Hello. What are we doing here? All right, I'm being told to wrap it up altogether. We got Martin? No? Well, we're back with you. Martin, I got you.
Hi, JD.
You were just wrapping up that finish, but we just lost that last little bit there. But we were talking GameStop there. Anything else there before we pivot to rapid fire?
No, I said I'll be interested to see what GameStop, if anything, has to say about its forward strategy. For the longest time now, they haven't taken questions in the post-earnings conference call. Maybe that'll change today, maybe not, but they do have a chance now to articulate their 2023 strategy, and I hope they take it.
Absolutely. Okay, let's pivot now to rapid fire. First up, why has Blackrock, I can read, why has Blackrock become the target, of activist investors? This is a good one. What's up?
It is a really good one. I mean, Blackrock is a company that I think a lot of us are familiar with in the professional space, but maybe the average viewer might have heard about it, but not necessarily understand its significance. It's the world's biggest asset manager, and they manage money that is valued at around 10 trillion US dollars, which is just a titanic amount of money. And therefore, the investment decisions that it makes have resonance all over the world. Larry Fink has run the group since 1988, and he has been a proponent of what's called ESG, environmentally, socially, and corporate governance-based investment-making decisions. In other words, he has tried to use his financial might to elicit and extract changes from the biggest companies and sectors all over the world. Now, this activist investor, which is based in London, is called Bluebell. And what they have said is that BlackRock hasn't gone far enough in some of its ESG ambitions and has actually been hypocritical with regards to its continued investment in fossil fuels and coal. So it sparked a conversation, certainly, about the sort of the broader mechanics of ESG and whether or not they generate shareholder value, or whether they are more of a political drive for someone who, of course, has reported political ambitions. Bluebell itself only has a very tiny stake, and I doubt that they're going to be able to extract the change that they're asking for. But they have begun that conversation, and this will be a broader one going into 2023 as investors sort of debate the idea as to whether these socially progressive goals are paralleled with the generation of shareholder wealth and shareholder value. It's one we've had for a number of years, and I would imagine it'll continue. And this story just reminds us of it.
All right, number two, why is Lowe's so optimistic?
This is an interesting one for me because it comes on the heels of what we saw last night from Toll Brothers, which is the biggest luxury home builder in the United States. Lowe's repeated its full-year profit targets. They have an investor day today in New York, and they're compelled basically to tell the market what they're going to tell investors in order to make sure that everybody has fair access to the information. But the fact that they have remained in sort of line with what they anticipate on a profit and indeed a sales basis is really important, because it shows how investors can find value in industries that are still in the throes of a downturn. The used housing market is rolling over. It's going to decelerate into 2023 as well. But Toll Brothers had better than expected earnings at the luxury home building level, and they actually had a reasonably robust forecast for building deliveries going into 2023. So you can find value there. Lowe's, of course, is a company that tends to do well when people have greater home building projects. And they do that oftentimes as a result of them being unable to sell their house and instead invest in its improvement. So for me, those were just parallel examples, JD, of how investors can find value in sectors that are otherwise trending downwards.
All right, we're almost out of time. Third and final, Georgia Senate runoff. What happened?
That's a big win for Mr. Warnock. His fifth election win in 2 years. He seems to be a professional pollster now. But a big win, even though it was only a narrow one over Herschel Walker. What it does, of course, is give that extra seat with respect to Senate control for the Democrats. And it will change, as a result, their perspective on legislative sort of agenda, because they won't necessarily be in the throes of the influence of people such as Joe Manchin of West Virginia and Kristen, I'm not going to pronounce her surname correctly, in Arizona. So to a great degree, this was a good result for the Democrats in order to establish firmer control in the Senate. But it also suggests that the candidates selected by President Donald Trump, who haven't performed nearly as well as anticipated in this election, may give us an inkling into his fading political influence heading into the 2024 race.
Democrats certainly hoping the great state of Georgia can become much more of a jump ball. Is it a crucial state, which it historically has not been? They want to compete for it to be a swing state. The great Martin Backerdax, thank you. We'll see you tomorrow.
Maybe Georgia's the new Florida, JD. See ya.
Yeah, Georgia, Georgia, Georgia. Imagine that's what it comes down to on election night instead of Tim Russert back in the day saying Florida, Florida, Florida. Could be. We'll see. All right, folks, that's going to do it for the Market Open here from the floor of the NYSE. Stick with TheStreet.com for more on these and all of the major market stories that matter to you, and we will see you tomorrow.